Welcome to The Explainer. On June 12th, 2026, we witnessed something that is literally going to be written into every single finance textbook for the next 50 years. SpaceX went public. And man, the sheer excitement was absolutely deafening. Retail investors alone poured over $100 billion in orders into the market on day one. There's no way around it. It's thrilling. As someone who loves innovation, I'm just as fascinated by their rockets as anyone else. But here's the catch. As a conservative, long-term retirement fund manager, I live by a very strict mantra. A genuinely extraordinary company is not always a great stock its current price, right? My job isn't to just buy a cool story. It's to protect and grow your capital. So today, we're going to look right past the hype and evaluate this historic event through the lens of a fiduciary. So here's our fiduciary's checklist for today. We're going to cover the historic SpaceX IPO, dissect their business segments, do a serious valuation reality check, look into the hidden risks and analyst divides, and finally, wrap it up with a prudent investment strategy. All right, let's dive right into part one, the historic SpaceX IPO, where they basically shattered all the records. We really have to just pause for a second and marvel at the sheer magnitude of the retail FOMO, fear of missing out, that drove this whole event. Seriously, the market appetite was something I have never seen in my entire career. Look at this number. $75 billion. That is the amount of capital SpaceX raised in a single day on the Nasdaq under the ticker SPCX. To give you some context, the stock opened at $135, hit an intraday high of $168, and closed at $161 on day one. But really, it's this $75 billion figure that truly underscores the unprecedented scale of what happened here. Now, for years, the reigning champion of initial public offerings was the oil giant Saudi Aramco. They raised $25.6 billion. But check out the SpaceX bar towering over it. It shattered the previous all-time record nearly 3 times over. It's like a giant eclipsing a shadow. The hype is undeniably real, folks. But as fiduciaries, we know we can't invest in hype. We have to invest in cash flows. Which brings us to part 2, dissecting the business segment. We're talking cash flow versus cash burn. Okay, we need to guide ourselves past all those flashy headlines and look under the hood. What is actually generating revenue versus just burning cash? Check out this massive 61% slice in this breakdown of SpaceX's $18.7 billion total revenue for 2025. That right there, that's Starlink, their satellite internet service. This is the primary profitable engine that is currently holding the entire company up, bringing in $11.4 billion all on its own. Now, sure, the launch segment controls an incredible 90 to 95% of global rocket capacity, and xAI is their super ambitious new artificial intelligence division. But make no mistake, Starlink is the real financial workhorse here. And hey, we have to give credit where credit is due to that impressive growth engine. As of March 2026, Starlink hit 10.3 million active subscribers across 160 countries. To put that into perspective, they more than doubled their subscriber count from just 4.6 million at the end of 2024. That growth rate is genuinely spectacular, and honestly, it forms the absolute bedrock of any bullish case you could make for the company. All right, let's move on to part 3, the valuation reality check. It's time to choose math over emotion. So at the first day close, SpaceX was valued at over $2 trillion. Let that sink in for a minute. That's more than Tesla, more than Amazon was at the time, and more than literally every other publicly traded space company combined. But we have to evaluate that against cold, hard math. If you take that massive market cap and divide it by their $18.7 billion in revenue, you get a price-to-sales ratio of roughly 112. Let's compare that to a mature, highly profitable titan like Apple, which trades at around 8 to 9 times sales. Heck, even NVIDIA at peak AI hype was only hovering around 25 to 30 times sales. At 112 times sales, you are paying a massive, unprecedented premium for future growth that hasn't actually happened yet. And we need to ground that space-age hype with this glowing red number right here. Negative $4.3 billion. Yeah, that was SpaceX's GAAP net loss in just the first quarter of 2026 alone. So why is it so high? Well, it's because their capital expenditures in that single quarter were $10.1 billion. That's more than double what they spent a year prior. And the vast majority of that heavy CapEx spending went directly toward xAI infrastructure. Basically, they're burning massive amounts of cash on an AI business segment that doesn't even generate meaningful revenue yet. Next up is part 4, hidden risks and analyst divides. We need to talk about the unknowns. When you combine a $2 trillion valuation with billions and cash burn, it creates some serious structural risks and, frankly, an extreme lack of consensus on Wall Street. Just look at the sheer level of disagreement in these price targets. Three serious research firms looked at the exact same company right after the IPO and came up with wildly different conclusions. Morningstar puts fair value at just $63. CFRA Research, they issued a sell rating with a $115 target, citing capital intensity and elevated expectations. And then NewStreet researches the bull, targeting $165. Guys, that is a massive $102 spread in analyst targets. When the pros disagree this widely, it visually reinforces that buying at the IPO price is highly, highly speculative. The reality is, nobody truly knows this company's intrinsic value yet. In fact, even the most bullish analyst out there, NewStreet Research, included this massive caveat. They said you have to look at this business over a 20 to 25-year time frame. Wow. So as a retirement fund manager, I gotta ask you, are you genuinely prepared to lock up your capital and wait 2 decades for the bullish business case? Things like orbital AI data centers and point-to-point Starship travel to fully prove out, just to justify today's sky-high price tag? And beyond all the financial models, there is severe governance and key man risk here. Look at this. Elon Musk controls approximately 85% of the shareholder voting power. All other public shareholders combined, they hold just 15%. This means public investors have practically zero ability to influence decisions, replace management, or push back on strategy. Plus, the CEO is splitting his time across multiple massive companies: Tesla, xAI, the Boring Company. Any major distraction or change in his priorities could materially impact SpaceX's execution. All of this builds toward a timeline of upcoming pressure. We had the historic IPO in June. Right now, we're in the fall of 2026, weathering this ongoing massive AI capital expenditure burn. But look ahead to December 2026. This is a critical warning for retail investors. The standard 180-day insider lockup ends. That means early employees, pre-IPO investors, and massive institutional holders can finally sell their shares. And when that much supply floods the market all at once, it creates intense downward price pressure, even if the underlying business hasn't changed one single bit. Finally, let's wrap things up with part 5, a prudent investment strategy. It's all about managing the FOMO. We need to set up some clear, actionable strategies that prioritize capital preservation over raw emotion, because jumping in blindly at a $2 trillion valuation, that is definitely not how you build a stable retirement. So here are 3 disciplined options you can actively follow today. Option 1, just don't buy yet. Wait for that December 2026 lockup dip. If insiders flood the market, you might snag the exact same stock at a much better entry point, and you'll have 6 more months of actual business data to evaluate. Option 2, if you absolutely must own it right now, build a small starter position. Keep it to no more than 3 to 5% of your total portfolio. That limits your downside while still capturing some near-term upside. And option 3, gain indirect exposure. Did you know Alphabet actually owns a roughly 4.9% stake in SpaceX? By owning Alphabet or even large-cap total market index funds, you get SpaceX exposure automatically, without taking on the severe concentration and valuation risks. Look, SpaceX is a genuinely extraordinary company doing things that will quite literally change the course of human history. But remember our mantra, a great company can be a terrible investment if you buy it at the wrong price. By running the numbers, understanding the lockup risks, and sizing your positions carefully, you separate the emotion from a sound financial plan. So I want to leave you with this final provocative thought as you look at your own portfolio today. Are you executing a disciplined investment strategy, or are you just getting caught up in a $2 trillion narrative? Simply put, are you investing or gambling on a story?